Picture this. You're staring at your trading view screen just after London close. ES, NQ or EURUSD doesn't matter. You've got a clean setup, higher time frame uptrend, pullback into demand, VW app bounce, RSI divergence, footprint showing absorption right at your level. You promised yourself this morning, if price taps that zone, I'm in. 1 hour risk, stop loss below structure, no moving it, no adding. The candle tags your zone, your cursor floats over the buy button, and your brain flips. What if this is the one that rips straight through? What if I get stopped out in front of everyone in the Discord? What if this starts a bigger drawdown? Your heart rate jumps. You zoom to higher time frames, redraw the same support line again, check 3 extra indicators. Open Twitter to see what the big accounts think. 10 seconds later, the candle launches without you. You watch it run exactly to your planned take profit. Unrealized profit that could have been yours just keeps climbing without you. Now dopamine kicks in, twisted. Okay, I missed the perfect entry, but if I smash market order with double size, I can still catch the move. You chase. Spread widens, slippage hits, you get filled right at the local top. The next candle slams down. You move your stop just a little lower to give it breathing room, and it still gets tagged. Red P&L, cortisol. Your brain screams, re-enter, revenge trade, get it back. This is where most traders live. Not in strategies, not in indicators. In the tiny 3-second gap between intention and click, between plan and self-sabotage. Here's the part almost nobody tells you. The legendary traders in the Market Wizards books weren't just running better setups. They were running completely different mindsets. Not the cliches like cut your losses short or let winners run. I'm talking about weird, almost backwards mental frameworks that go against your instincts, against your dopamine wiring, against everything school taught you about being right. Most traders lose money. That's not an insult. That's how this game is built. Fixing your strategy without upgrading your mindset is like putting a Ferrari engine on square wheels. So in this video, we're going to unpack 10 rare mindsets from legendary traders, the kind you feel in your nervous system, not just write in a journal. They'll rewire 3 things: your behavioral biases, hesitation, moving stops, revenge trades, overtrading, in chop, your brain chemistry, dopamine hits from green P&L, cortisol spikes from red positions, adrenaline during volatility. And the paradox of trading, why the best trades feel uncomfortable, why more analysis can mean worse results, and why tighter stops can create bigger losses. None of this is financial advice. Trading is risky. Most traders lose money. Past patterns don't guarantee future results, and risk management is survival. Let's start with why your default brain cannot think like a market wizard. Because it was never built for candlesticks and leverage. Your brain was built for tribes and tigers. In real life, certainty keeps you alive. If the bushes move, you assume danger. If something looks different, you freak out. Your amygdala is wired to scream, do something, the moment there's uncertainty or pain. In trading, that wiring becomes a weapon pointed at you. You get entry hesitation paralysis. Your prefrontal cortex sees the setup, but your emotional brain whispers, wait for one more candle, one more confirmation. By the time dopamine wants the reward, the move is gone. You get exit greed extension. Your trade taps your plan to take profit and the voice says, just a bit more. One more R. Closing at plan suddenly feels like loss because your dopamine has already priced in the fantasy of more. You get stop-loss removal syndrome. Price creeps toward your stop. Cortisol surges and your brain invents stories. This is just a sweep. Market makers are hunting stops. You move it. Your 1 hour loss becomes 3, then 5. You get revenge trading loops. The first loss triggers shame. Shame spikes cortisol. Cortisol narrows your focus to fix it now. And you start hammering market orders in random directions just to make your P&L hurt less. You get overtrading compulsion. Boredom feels unsafe. Silence feels wrong. You manufacture action. You start seeing flags where there's noise, breakouts where there's chop. Pure chart pattern hallucination. Dopamine is screaming for stimulation, not edge. Then there's the paradox layer. In normal life, comfort is usually a good sign. Familiar, convenient, safe. In trading, the opposite keeps repeating. The perfect setup that feels obvious to everyone is often late, crowded, over-leveraged, one tweet away from liquidations. The best trades usually feel uncomfortable at entry, right where your brain is yelling, "This looks stupid. What if I'm the only one wrong?" More analysis, more indicators, more timeframes, more voices can reduce clarity. Your limited mental bandwidth gets split between conflicting signals. Your conviction goes to zero. Tighter stops, because I want better risk reward, often create bigger losses. You get chopped out 10 times in a row, your confidence collapses, then you size up to make it back and blow up. More screens, more feeds, more Discord rooms don't give you more edge. They give you more noise, more mirror neuron FOMO, more reasons to abandon your system. Traders like Mark Douglas hammered this. The market is an environment of uncertainty that doesn't care about you. Your only real edge is your beliefs and attitudes about risk, randomness, and responsibility. So let's bring in Marcus. Marcus isn't a pure discretionary scalper or a fully systematic quant. He's something in between. The algo hybrid. He started as a coder, building scripts to mark liquidity zones, VWAP deviations, and session highs and lows on TradingView. Then he binged Market Wizards, The Disciplined Trader, Trading in the Zone, Brett Steenbarger, The Way to Trade. He stopped asking, what are their entries? And started asking, so how do they think? Now he trades futures, ES, NQ, sometimes EURUSD, and gold, main chart. 15-minute for structure, 5-minute for entries, 1 minute only for execution, never for new ideas. On his first monitor, naked price action with key levels, a couple of moving averages, VWAP, volume profile. Second, order flow, footprint, delta, level 2. Third, his journal and a dashboard, risk per trade, max daily loss, current drawdown. His platform forces every entry to have a stop loss and take profit attached. If he cancels the stop, his platform auto-reduces his size on the next trade. He literally punishes emotional behavior with mechanical rules. Years ago, he blew up a small account revenge trading on margin after watching flip 1K to 100K videos. That pain became his turning point. He built 10 strange mindsets from the traders he admired and taped them to the bottom of his main screen. Let's walk through them. Mindset 1. Survival is a strategy. Before he looks at a single candlestick, Marcus checks 3 numbers. Risk per trade, and 0, 5% of equity. Max daily loss, 2R, and max margin. If he hits the daily stop, his trading is over. Platform locked. No exceptions. The goal of the day is not make money. It's end the session with my risk limits intact. When survival is the goal, revenge trades don't fit. They violate the mission. Mindset 2. Trade the distribution, not the trade. Marcus doesn't care if this trade wins. He thinks in sets of 20 or 50 trades. Each setup is one sample from a probability distribution. A winner doesn't make him a genius. A loser doesn't make him trash. They're just data points. When he feels that cortisol spike on a red trade, he reminds himself, one of the losers in the set. Good, the edge is alive. That disconnects his self-worth from single outcomes. Mindset 3. Pre-accept the loss. Before he hits the button, Marcus imagines the stop being hit. He feels the small sting of that 1R loss before he enters. If he can't emotionally accept it, he lowers size or skips. He treats the risk as money already spent at entry, tuition for information. So when price moves toward his stop, he doesn't move it. That cost has already been paid. Mindset 4. Emotions are data, not commands. On volatile days, he expects dopamine and cortisol to swing. If he suddenly wants to triple size after a big green candle, he tags it mentally, dopamine. If his chest tightens and he wants out of a valid trade just because the P&L flickered red, he tags it, cortisol. The feeling is real, the story attached to it is optional. Instead of obeying emotions, he observes them. At day's end, he journals, what was I feeling before my worst decisions? Over time, his own patterns become just another data set. Mindset 5. Plan B is part of Plan A. Most traders only plan their ideal scenario. Marcus plans the mirror image as well. Before the open, he writes, "If we reclaim this resistance with strong volume and aggressive delta, I'm long. And also, if we fake out above and slam back into the range, I'm flat or short from the failure." That way his brain is ready for both outcomes. He doesn't need one story to be true. This kills chart pattern hallucination and bias marriage. Mindset 6. Boredom is a danger signal. On slow days, most traders start forcing trades just to feel alive. Marcus treats boredom like a red light on the dashboard. If he catches himself clicking between timeframes, hunting micro setups, he steps away, 10 minutes off screen. Or he goes into replay mode, marking past trades, capturing screenshots, refining rules. He still works, but not by gambling in a dead market. Productivity becomes improving his playbook, not increasing trade count. Mindset 7. Flat is a position. When there's no clear setup, trend unclear, volume thin, levels messy, Marcus doesn't reduce size. He goes to zero. Being flat protects margin and mental capital and protects his pattern recognition from being trained on noise. His rule, my job is not to be in the market. My job is to take trades when the market pays me to be in. Sitting out isn't failure. It's high-quality risk management. Mindset 8. The best trades feel slightly wrong. The trades that changed his equity curve all had two traits. Mechanically, they were A+, multi-time frame confluence, clean liquidity, solid risk-reward. Emotionally, they felt uncomfortable, shorting a euphoric parabolic candle into higher time frame resistance while Twitter screams new all-time high incoming. Buying a quiet pullback into support on a red-heavy morning when everyone feels bearish. Now his rule is simple. If a setup matches his system but feels scary purely because it violates crowd emotion, that discomfort is a positive signal. If a setup feels amazing because everyone agrees, he sizes down or passes. Mindset 9. More rules, fewer decisions. He used to believe freedom meant deciding in the moment, that almost guaranteed emotional trades. Now he believes real freedom comes from having so many predefined rules that the live session feels almost mechanical. He has rules for how many losses in a row trigger a break, how long after the open he must wait before first trade. What overtrading means, for him, more than 4 trades in a day without at least one A+ setup. How he scales out: first partial at 1R, stop to break even, next partial at 2R, final at structure. The more he codifies ahead of time, the less room his emotional brain has to improvise disasters. Mindset 10. You are not your P&L. When he tied his identity to daily results, green meant I'm smart and red meant I'm garbage. His brain couldn't handle randomness. Every loss felt personal. That's how you end up moving stops, doubling size, and blowing up. Now he measures himself by process. Did I follow my risk rules? Did I take valid setups without hesitation? Did I avoid impulsive trades? Did I journal and review? A day where he loses 1 or 2R following his plan is a win. Because that's the day his brain gets trained to respect structure over emotion. So what does life look like when these mindsets aren't just notes on a sticky pad, but habits in your nervous system? Imagine tomorrow. Same trading view screen, same instrument, same levels. Price taps your zone. You feel that jolt in your chest, and you recognize it as adrenaline, not a signal from the universe. You've already pre-accepted the loss. You know it's one trade in a series. You know your survival limits are in place, so even the worst-case scenario is contained. You take the entry at proper size. No last-second doubling. No tightening stops to fake better. Risk, reward. Price wobbles. Social media panics. Discord disagrees. You glance at your plan B. Volume still aligns with your main scenario. Order flow still supports it. You stay in. The trade either stops out exactly where you planned, and you log it, breathe, and move on. Or it runs to target while you scale out by rule, not by dopamine. You finish the day maybe up 1R, maybe down 1R. But mentally you're flat. No tilt. No revenge impulse. No identity crisis. You journal. You grab screenshots. You shut down the platform. Over weeks, those small, boring days stack. Drawdowns shrink. The random, spiky equity curve starts to look like a staircase. Quarter. You still have losing days. Everyone does. Most traders lose money because they never learn to think like this. Not because they picked the wrong indicator, but you're slowly leaving the crowd of traders who need the market to validate them, and joining the tiny group who quietly extract money from a chaotic system by aligning their mind with how markets actually work. Don't try to install all 10 mindsets at once. Take one. Write it at the top of your journal tomorrow. Flat is a position. Or trade the distribution, not the trade. Or pre-accept the loss. Then spend a week living just at one in every trade. Because you don't become a legendary trader by knowing more tips. You become one by thinking differently and then having the discipline to act on that difference. One entry, one stop loss, one drawdown at a time.